Hi, Danielle, Lisa and Abbie. Thanks ever so much for joining us. Right, I will kick off with the introduction now. So this is the Positive Investment panel talking about asset owners and asset managers' impacts on the real economy. For those of you who've just joined, hello and welcome to the Positive Investment Symposium. Positive Investment Imperial is a group of students at Imperial College Business School aiming to educate and galvanise actors towards positive investment practices. This symposium is a culmination of our work this year on research, education and endowment, and we're very glad to have you here with us today. I'm Luke, one half of the endowment team of Positive Investment Imperial alongside Beauvilain, and I'm a master's student on the Climate Change Management and Finance course. So this panel, as we've mentioned, will be looking at how assets, both ownership and management, can be used to shape sustainable outcomes. Now, fortunately, we are joined by three panelists with a wealth of experience across exactly these issues. To save them having to highlight their own brilliance, I'll do it for them with a quick introduction, and then we'll head straight into the panel discussion. So hopefully this will be pretty much some of the last you'll hear of my voice, because that is not what everyone has signed up to hear. So Danielle was the founding director of Friends Provident Foundation, an independent charity endowed by Friends Provident PLC after the demutualisation of Friends Provident Life Office. The mission of the foundation is to create a fair and sustainable economy, and under her leadership, the foundation has developed an international reputation for innovative funding and investment practice, and is at the forefront of rethinking the role of philanthropic resources in the UK. Now, Abbie is the head of sustainable investing at Jupiter Asset Management and is the fund manager of the Jupiter Global Sustainable Equities Fund, a strategy which invests in high quality companies, leading the transition to a more sustainable world. Since joining Jupiter in 2006, she has dedicated her investment career to sustainable investing, building and designing a rigorous investment framework that embeds all stakeholders into fundamental analysis. And Lisa is head of sustainability and ESG at Impax Asset Management. There she is responsible for the development and oversight of sustainability and ESG analysis, including overseeing the stewardship work in the listed equity team. She is the chair of Impax's ESG, Sustainability Lens and Environmental Committees, and also co-heads Impax's Impact Investment work. Righty, so with that, we will start off with the panel discussion. The way it'll work is I'll offer some broad discussion points which are open to all panelists. Please hop in and out as and when suits and you see a question that interests you. So I think the first one is that climate change obviously presents unique risks and opportunities to asset owners, and that's gaining traction in the media and with the general public. But how well do you feel like your industry currently recognises this? Is it all the way there, or are there steps that still need to be taken before climate change is fully accounted for by asset owners and managers?
Abbie, do you want to kick off? I don't think I've got an industry, to be fair, but I'll have a go anyway after you.
I can't, for sure, why not? I think that's officially known as the hospital pass, but anyway, we haven't had a prep call, but anyway, let's go straight into it. So what the question is, do we think that the industry is moving fast enough effectively given the noise around it? And I think, from what you just said, Luke, I think no, the short answer is not in asset prices, which is probably the key area from our perspective as an asset manager. We just heard from David how dynamic this space is. I think it's worth reflecting on that, because ultimately this conversation I'm sure we'll come on to is the intersect of fiduciary duty and broader factors. You know, for us as a team and an investment approach, you know, we see significant carbon capital at risk in the market, and I think there is still inertia in pricing these externalities across the market. And I think it is worth just reflecting, just to take a moment, you know, of the whiplash that we've all had in the last 2 years in the context of global policy momentum. You know, it was only a couple of years ago that in the US, you know, effectively ESG considerations were ineligible, excuse me, for consideration based on pecuniary definition, you know. And I think as the world races to rebuild from that previous chapter, you know, the next chapter will be pivotal. And you know, if I think you mentioned, you know, I've been doing this for a few years now, and I think this is the 15th year of seeing the momentum build. And even 2 years ago, I remember attending a conference at a large investment bank, and they hosted their head of oil and gas analyst there, and their opening comments was that they were only going to talk about climate change because there was a lot of clients there who wanted to hear it. That was kind of extraordinary proclamation. That was 2019. And I think given the systemic nature of this topic, there is a big disconnect still. And I think there are a few things which I'm sure we're going to discuss in terms of standardization and how that can support and correct that, the work of TCFD, global policy alignment, particularly between China and the US, where we've had some progress recently. Will be a key focus, and the pandemic has obviously accelerated the urgency of these factors as well. But I do think that we are yet to see that harmonisation on fiduciary duty. And for us, as you said, as people who've been dedicated to this, or investors who've been dedicated to this for a long time, we really see an urgency of embedding these considerations across asset allocation decisions. And I'm not sure the can be kicked down the road anymore. The column inches don't reflect the matching of allocation on the scale that is required to mitigate these risks in the context of return to pension funds. So I think that's what I would say on that particular question.
Can I just pick up the question about returns as well? Because one of the things I'm really interested in as a holder of philanthropic capital, so essentially it's capital which is directed to help us achieve our charitable mission. So, I mean, we're not that unusual, but we're slightly unusual in that we think of, our money as part of the charity. It sounds like completely obvious, but in fact, weirdly, foundations quite often think of their money as something that earns them money. So they kind of put it out there to do whatever it does, and they don't really kind of worry about what it's doing. And they get on with giving away grants or being nice to animals or whatever. But in fact, our view is our money is doing something for our charity, and we should know what it is, because it shouldn't conflict with what our aims and objectives are. So if you're thinking about it that kind of way, one of the things because our mission is about creating an economy which serves society and the planet, and actually doesn't create problems that then the state and philanthropy try to put right all the time, and we're always playing catch up and losing. You can see that in terms of environmental degradation and in terms of biodiversity loss. Can we design an economy that doesn't do that to start with? And one of the things you start doing when you start digging into that is you look at your asset allocations and exactly do the things that you should do, as Abbie's outlined, and be thinking about, how can we deploy this money in a sensible way in the market to achieve both return and our charitable objectives. But actually you start thinking, well, hang on, what's this thing about return? What is it? What growth assumptions am I building into what I'm asking Abbie and her colleagues to do? I'm saying I want all this really nice stuff with sustainability, but I also want 4% or whatever I'm saying. And it's well, can we actually support that kind of expectation built into every portfolio that's operating in the market in a sustainable way? Is that actually an ongoing possibility? Or do we have the really hard work? And I'm hoping I can enlist loads of intelligent young people at Imperial in the real, to me, intellectual work of working out how you can actually construct portfolios and think about the allocation of money, which does not necessarily have, basically, there's no way we're going to meet net zero in them. I mean, implicit in a growth assumption. So, I mean, these are some deeper questions which go beyond when you start looking at the asset allocation, when you start moving toward actually what are your growth assumptions that you're actually building into your asset allocations. And that's kind of the game that we're currently at. There are a range of people beginning to think about this, but to us, it's a really fascinating area.
Maybe a couple of words on that point from me as well. So I would say, I mean, the financial industry has come a long way, in particular in particularly Europe, I would say, and the US is moving as well. I mean, not too long ago, sustainable investing and ESG was about exclusions that were quite often relatively sort of, let's say, subjective, etc. Then came the whole aspect of ESG integration, which you can perhaps sometimes ask what it does at the system level, but it probably at best is a sort of incremental aid. And now we have quite clearly moved into this sort of area of much more focus on solutions, on impact, on the opportunity side. And as we heard, David mentioned the 2 to 3 trillion investment required every year as well, but also on the risk side, much more focus on, much more thoughtful approaches, etc. I don't think we're quite there yet, but it is becoming more science-based, etc. So we've come a long way. But I think what is quite clear is that it is fantastic for listed equities investors, for example, or even, well, let's say listed equities investors to focus on sort of solutions and companies that are providing unmet societal, environmental needs, which are really sort of the gold dust and incredibly required, of course. But the fact that investors sort of invest more to them is not creating necessarily the real world impact that we really need. What is really required as well is the sort of new build, the infrastructure that is fundamentally sustainable and environmental, etc. The sort of real hard stuff from scratch. And I think that's where we're still struggling as a society to sort of get those investments in. Who's going to take the risk for those? Who's going to accept the lower returns that Danielle was talking about from those kinds of more almost socio-environmental type investments? So I think that's where there's a very clear shortage of capital today.
Sure. And I just wanted to sort of pick up on that point about the sustainable economy. Obviously, sustainability is a lot broader than just reducing and mitigating climate risks. Are we in danger of this sort of sustainable investment movement being defined purely by climate as the focus becomes so heavily on that? And what would we miss out on, I guess, if we were to take that more narrow climate approach as opposed to the holistic sustainable investment practice?
Just to bring up David's point, I think you get Trump personally. If you neglect democracy, if you neglect the social side of it, you actually start leaving people out of the equation. And I think it's easier, obviously, it's a lot easier to count, to look at climate. I mean, there's not more kind of agreed metrics. I think metrics are really important in this field. And obviously, Abbie and Lisa know a lot more about that. But just from our perspective, because weirdly, as a foundation, we are not a climate funder. So we're starting from a kind of, the economy is constructed by society, and society needs to also get more articulate about what it wants from the economy, instead of just like, taking whatever is pumped out and say it's all good because, we've got growth and wealth. So I think there's a kind of much more active conversation between society and finance and institutions, financial institutions, as well as the economy as a whole.
I think I think it's right to point to there's a requirement for flow of capital for sure to support that transition element from a technology perspective. But I think if we take a step back and look at the economic frameworks available to us in the context of delivering a more sustainable world, then we have to focus on not just what products or technologies are being sold, but also how companies behave in that mitigation of environmental impact. And to understand that intersect and balance a broader stakeholder, whether it's the planet on which we all depend, the people with whom we all coexist, or the profit that, as we've heard, we all require for our long-term savings, and that balance. And I think what we're seeing at the moment, which is quite interesting, is you've got legal, regulatory and commercial convergence. And I think for the conversation conversation for trustees and asset owners, this conversation should fast become about looking at the primary considerations of fulfilling fiduciary duty, rather than necessarily nice to have add-ons, given that convergence in the regulatory and legislative side. And I think, as Lisa's mentioned, there are different asset classes available, right? Whether it's on a private equity basis or credit basis, but also public listed. And I definitely come to this conversation from a public listed markets perspective. But I do think if capital markets meaningfully start reflecting the embedded carbon within the economy, then these broader factors will start impacting asset prices, not least because companies who have mitigated that risk will have less externalized cost to internalize, therefore supporting their competitive position. And also supporting better planetary outcomes. But we're also perhaps going to go on to this as well, as how that impacts sort of like the social element of it. And I think if we start thinking about it through that lens, then we can fast align the complexity around that legally defined definition of fiduciary duty with broader asset allocation in the context of planetary outcome.
Yeah, I would add there that we do definitely see the sort of climate being systemic risk, and another one would be the whole issue of inequality. I think it is interesting and very welcome, and I hope it may last, that the focus has shifted a little bit more towards the social aspects as well, with COVID and post-COVID and during COVID, and rightly so. I think it's been a real eye-opener, of course, all the thousands, hundreds of thousands and millions of employees who have been very invisible in the system, and that all of a sudden are at risk, but also absolutely essential to run our economies and our businesses and all our activities, etc. So I do think that the social aspects of sort of sustainable and ESG investing will be here to stay. Whether there's going to be that excitement we saw, for example, last year, I'm not quite sure, but I do hope so. And it's very interesting, I think, the whole aspect of looking at actually climate and inequality, because they are incredibly linked as well. And obviously, we do know that climate will be affecting those who are least well off most. But we also do see, to some extent, that where we do increase diversity and inclusion, we can also improve, from an investment perspective, climate outcomes. And there's quite a lot of body of research supporting that. And whether we're talking about just simply more diverse companies having significantly more and better disclosures when it comes to sustainability and climate issues, or better management of climate processes and outcomes, etc., but also having much more innovation, for example, and R&D spend in those companies that are more diverse, I think is a very, very interesting aspect to keep in mind and really look out for as a way of identifying and selecting companies as well. It's a very important signal for us of company quality and what the outlook, attitude, and quality and character of companies are. Is sort of this whole aspect of equity, diversity, and inclusion.
Sure, I think one of the things that we've really picked up on the course this year is that sort of symbiosis between climate and inequality. I just picking up on your point, actually, Abbie, that you mentioned, so it might be a question for you about embedded carbon. If investors increasingly measured their climate exposure and tried to mitigate this risk, etc., what would the impact look like on the securities that find themselves on the wrong end of that? I mean, I guess from a university perspective, we see a lot of the engage versus divest debate. But yeah, what would that look like in capital markets?
Yeah, it's a really interesting point, and actually I'm contributing to the syllabus for the CFA climate-related syllabus, specifically on this. So I'm trying to bring all my thoughts together. So we do have significant carbon capital risk at the moment, and it's not just a question of divesting or mitigating exposure by not investing in the carbon intensive industries, especially when they're carbon intensive industries where there is no alternative. So take cement, for instance, at the moment, there's not a scalable alternative currently to that. And if cement was a country, it would be the third largest emitter in the world. So if we think about this, it's not just as simple as divesting and mitigation. It is much more complex than that. We need to adapt how capital is priced and reflect those externalities into those asset prices. So if we take carbon, because there's been a lot of foundational work in our ability to be able to price that risk. We've got TCFD maturing those foundations, and there is a greater visibility in the next few years of that internalization of cost. And so in effect, these carbon costs will become a byproduct, if you like, of doing business, or will affect shift from being a byproduct of doing business to a direct cost of business. And having a reduced carbon footprint tells us as investors that the companies are thinking about the long-term health of their business as well as their responsibility to the environment. And by having a reduced carbon footprint, they effectively will have less cost to pass through, which supports competitive positioning, supports cash flow resilience, supports balance sheet, and ultimately margin. So again, we come back to that intersect of fiduciary duty. And I think companies who have recognized the need to transition quickly and efficiently to a net zero economy that supports a 1.5 degree climate scenario, those companies are intrinsically better positioned from an investment perspective as well as from a planetary perspective. And that's where we spend a lot of time focusing our research of understanding that intersect of where companies are positioned in order to best protect client interests. And I think you can see it's a really interesting geopolitical backdrop as well as carbon will have a price. We can now measure it so we can manage it, and whatever that mechanism will look like, whether it will be fiscal or whether it will be allowances based, or cap and trade, whatever it may be, we know that there will be mechanisms coming into force in the next few years. We've got COP26 later this year, which I think, given the climate summit out of the White House in the last couple of weeks, that cooperation signature, signed on Chinese soil, I think is really significant, brokered by John Kerry in the context of delivering against the inevitability of some of these factors. And for us, when we're looking at these issues, I think it's understanding that the company positioning on it, but also the understanding of that geopolitical dynamic as well. The European Commission have given an early indication that there will be a border mechanism, so import tax effectively on embedded carbon within products and services. It's a really interesting dynamic, and ultimately, if we take it back to basic fundamentals of research and stock selection, these are intrinsic fundamental competitive advantages for companies who have managed and mitigated this risk on a forward basis. So we like bringing it back to that intersect, because I think it helps support that narrative, and that's potentially the speed of allocation that trustees can adapt their own investment committee allocation decisions to as well.
Sure. And I guess maybe Danielle, as an asset owner, Abbie sort of touched on there the need for the conversation to be a bit more nuanced than just divest or engage. Is that a view that you hold as well, or is it a case for an asset owner that it very much needs to be a divest or engage discussion?
I think it is more subtle. I suppose my feeling is we've kind of got to use every tool we've got, and we don't have time to be kind of decide it's either this or this or do regist on anything, to be honest. I mean, as a foundation, we actually feel that engagement is an incredibly underused tool, and asset owners perhaps need to sort of tool themselves up and actually resource themselves and make sure they have the skills to engage when it's appropriate to. So I mean, as a foundation, unusually in the UK, we actually buy. We have a pretty well. We have an ESG, largely ESG and impact set of portfolios, but we also actively buy stocks in companies we want to engage with, who we would not hold. So we buy things that perhaps are not things that would get through our screens, because we want to have an engagement with them. And we're currently been working with Drax Power Station to work on their transition, because we're working with the LSE actually on transition, so a just transition plan, particularly in Yorkshire where we're based. And we are actively engaging with Drax on how they can develop a transition plan, which takes on board the impacts on communities of them being there and them not being there. So it's all very well for investors or even asset owners to pound the table, but engagement actually starts taking a whole new set of understandings when you think about the transitions, which will have direct impacts on people on the ground, on communities. So in Yorkshire, we know what a transition looks like when it happens violently. When industries shut, when coal mines shut, communities are left behind. And so we want to transition to a net zero, but we also recognize that will have real implications for real people on the ground. And so therefore engagement takes a different kind of tinge when you're talking to communities as well as companies. So that to me is like a kind of richness in the idea of engagement. But we also feel there's time sometimes to just say, you know what, you really are not doing this. This is not happening, and we need to pull the money. The capital needs to move, that's not. I mean, our position isn't necessarily divest, but we also recognize we don't hold certain things. So it's a very subtle game, and I think we just need to use every tool there could possibly be. So we don't really sort of ally ourselves on one side or the other of that what we think was a false binary.
Sure. And we've sort of mentioned a little bit the notion of integrating sustainability into pricing. I was just wondering how active asset managers or owners are in trying to influence the mechanisms which will integrate sustainability into pricing, I guess, such as carbon pricing, etc. Or are there limitations to your influence in that space?
I didn't know if did Lisa want to come in? I didn't want to kind of cut her off.
Yes, I mean, we would definitely be involved in policy advocacy more broadly, whether that is incredibly specifically focused on pricing issues, probably not. But obviously, we do know that one of the most needed sort of mechanisms are the right incentives and the right sort of pricing systems that are needed. But there are also many other things that need to be developed, and in some cases changed in the system when it comes to policy and regulation. And that is an area that Impax has been focusing on for a long period of time. And really our focus there is at the sort of very high level, it is around ensuring that policies become much more sort of long-term, and that they are clearly giving the right signals, and the signals are absolutely involving the sort of pricing and right incentive structures over a long period of time, in order to give the right confidence and again the signals for long-term investment into the very much needed infrastructure, for instance, required for a transition to a more sustainable and low carbon economy. So yes, we are very much working on that, but I wouldn't say specifically and only on the sort of pricing side.
Sure.
I would just say, Luke, I think the intrinsic problem is that the data is still unaudited. So you've got an unaudited, self-reported data set that lack standardization in measurement. So it's really nascent. It's such a dynamic space and it's so fluid, but before you can reliably price it, you need to have that standardization in place. And I think no surprise, given the decades it took in the context of financial reporting standards to be standardized. You know, and there are hundreds of different data points as well within the broader stakeholder analysis. Even how we measure carbon on a scope 1 and 2 basis, and of course the materiality lies within scope 3. Category 11 use of product, you know, is notoriously difficult to quantify across sectors, and so I think we're dealing with a hugely complex data set that still lacks that required certification, and I think, you know, the auditing opportunity that we have for the next few years should be a priority in order to get a more reliable data set input into our DCF models effectively, and I think, you know, this is what will be the priority in the next couple of years, is getting that reliability of information that becomes audited, not self-reported, and then we can get the consistency, and then I think there'll be a much stronger correlation in asset prices reflecting that embedded carbon point. But for us, because we're trying to be at the front end of that transition, identifying those companies, we're sort of, you know, we're running our own sort of analysis and assumptions based on where we think the market can go to, and you know, it's a really fluid space, but that's the bottleneck at the moment, is the lack of standardization and unaudited nature of the data set.
Can I just ask a question, actually, Luke? Sorry, I just wanted to know, in terms of what Abbie was just saying, I'm really interested in like data sharing in this space. I mean, I'm pretty sure you probably do. Is that something that is a way of being, that you kind of put the data that you're using for your analysis in a place that other people can look at it and scrutinize it, and perhaps build on your methods?
So typically we rely on reported information from companies, and then you have multiple data sets available in the market that you can buy in. One of the concerns that we have sometimes with those broader data sets is that they use sector averaging, and very few sectors are homogenous from a product or positioning perspective. And perhaps one of the things we may come on to in the second half of this panel is the regional requirement to rebase some of the analysis, particularly for global investors. So comparing like for like on a regional basis rather than on a global standard. And that's a really interesting debate as well that I think people have some strong views on. But so I think at the moment it's about getting the information that's just out there. You know, CDP, the transition pathway. You know, there's some really strong public initiatives that give us that data set to work with. In terms of modelling it into cash flow, there's a huge amount of assumptions that can go into that, and that also raises questions on the reliability of those assumptions. And for us, what we try to do is balance probability with those inputs, and also look at it in the context of the market inefficiency of false positives, where you get very good disclosure against all of these multiple data points, and then you get false negatives where you don't have the disclosure and resource support from corporates, and that leads to an unnecessary penalisation. I think for us as active managers with a concentrated book, we hold 40 companies in our fund, you know, we can focus on the granularity of that. There are 10,000 available listed, you know, issuers within the global equity space that we could consider. We're invested in 40 of those. So I think there are huge data sets out there. They are evolving, they're dynamic, they're fluid, they're getting more reliable. But that's where I would like to see the focus of global policy in the next year or so, focusing in on how we can get a more reliable, auditable measure. I mean, the industry has gone to carbon intensity because that supports growth rather than absolute emissions. But then we've got a huge debate going on at the moment in the context of how do you even calculate net zero emissions. You know, it's a very heated debate in the context of avoided emissions, particularly around financed emissions. And actually what we need to see is a reduction in absolute emissions, and just even the basis for these calculations is still dynamic. And so I think that's the point and of this conference is it's driving transparency, better standardization, so we as material risk takers can make more informed decisions when allocating that capital.
Sure. And then I guess we've spoken a little bit about what can be done, and sort of I was wondering maybe on the flip side what you found the limitations are as an asset owner or a manager, and then at the point at which you have to work cooperatively with others to ensure work's done in difficult to reach spaces. Everyone's being very polite. Feel free to jump in.
Yeah, well, I think we've discussed the sort of social side, which I think you have that whole issue of limitation of data. And even if you had, let's say, perfect data, everyone would be disclosing on key performance indicators relating to social and sort of human capital type issues. I think it might still be difficult to get really to the bottom of, okay, are these for example, the employees of this company X, are they happy? Are they motivated? Are they productive? Is the culture and the values of this company, is it truly inclusive, etc.? That's definitely a difficult sort of area. The way we have so far been found the sort of best way of trying to get to that whole incredibly interesting, and I think there's a lot of opportunity investment opportunity, alpha generation opportunity in trying to really understand the culture of companies and what's actually going on within those companies. But it's hard to get there, and our approach so far has been really through engagements and discussions with a broad set of people within firms, not just the IR and the investor relations people or the most senior executives, but also try to get a sense of some of the specialists who might perhaps be more in the sort of middle management role, etc., and try to get a sense of that. But I think that's definitely an area where you say where the difficult to reach spaces would definitely be that. But at the same time, as mentioned, I think that's a great opportunity for those investors who really can get to the bottom of that. There's a lot of very interesting research showing how how important it is that companies have strong cultures that lead to happy and motivated and very productive staff. That makes a huge difference. And I think sometimes the sort of materiality flag is mentioned there. Human capital is not material for this company. I would argue that for most companies, human capital and people are really material. Every single company is run by and with people. So I think that's definitely an area. And you mentioned the sort of collaborative in your question, the collaborative aspects of that. And I think that's certainly helpful. And I would also think about it as a sort of as a partnership to an extent. We try to think about engagements as partnerships with our companies. We are long-term holders. And so we view ourselves as a sort of free, friendly consultant or a critical friend, and form these very long-term discussions and engagements and dialogues with the companies that we own and hold to develop step by step, whether it's around human capital, whether it's around other sustainability issues, perhaps climate, etc. And I think where we would see, for instance, that we can't quite get further, we cannot quite access the right people, etc. That might be where you think about methods of escalation, and whether again that's sort of approaching other types of senior executives, or I think one way that we found quite effective is to seek other venues of engagement. So a good sort of effective way has been to approach companies during conferences, for example. Why is that good? It's good because you will, in many of those cases, have not just one or two of the top managers of a company, but often a big set of them. And it's interesting when you as a portfolio manager, for example, ask about, okay, so where did we've been discussing this particular climate issue, and where did you get on that? And that's often when, for example, the CEO turns to the head of sustainability or IR saying, have we been discussing that? I haven't heard this, etc. That's been a sort of nice snowballing effect, and where we've really seen engagement move ahead. But then obviously the whole issue of collaborative engagements with other shareholders, with other organizations, but also with for example, some of our asset owner investors, etc. We are doing collaborative engagements together with them. And there's the obvious issue of having a bigger voice, etc. But it really is a good way of sort of escalating a conversation, no question.
Sure, thanks very much, Lisa. I think we will effortlessly transition now into the sort of Q&A part of the panel. The conversation you had earlier, Abbie and Danielle, about metrics and disclosure has sparked a couple of interesting questions in the conversation. The first is from Alex Clark, who asked, what is the set of metrics investors should be looking at to affect if they actually want to contribute to systemic change, i.e. where do investor activities make a difference to the real economy on climate beyond just shareholder activism and lobbying for green policy?
I'd be really interested in Abbie's thoughts on that, because I was really struck by your comments, Abbie, about kind of fundamentally looking at business models, because it feels to me that that's, you know, what we need to be looking at. Is not just, you know, perhaps a kind of technical, you know, calculations going on of carbon intensity or what have you. It's actually much more about, you know, how do you make your money? You know, what are the fundamentals about that? And how does that work in terms of the kind of broader goals that we're looking at? Because to me, I'm really fascinated in terms of, you know, that fundamental research, the degree to which, you know, that could be, you know, I understand obviously it's alpha generation, each company's proprietary, but it feels like quite important to start sharing and understanding the nature of profit generation, like where money is made and how it's made by companies, and really understanding good and supporting good business models more broadly. And if that information is, you know, purely proprietary, then that conversation cannot be had more broadly beyond the boardroom. So I'm actually interested in, there is a lot of metrics generated, a lot of information generated, which doesn't actually ever become market information that's shared. And I'm just really wondering of the potential for that kind of thing.
I'm not sure I'd agree with that last statement, just in the context of it not being shared or market information. Listed equities have very tight transparency disclosure rules around them. So any information that you're embedding should be publicly available information. It certainly is for our process. For sure, there's no such thing as a perfect company, so engagement is an important part of the narrative. But ultimately, for a fund like ours, you know, our investment framework would have failed if we're having to have sort of high-profile shareholder resolutions, because we're trying to invest in the leaders, not strong-arming management teams to do the right thing. So we use our framework to identify what does leadership look like given a company's sector or geography, or put more plainly, what it sells and where it sells it to. So I think from our perspective, when we're thinking about these things, rebasing to regional norm, looking at materiality and relevance, and not getting distracted by blanket disclosure against all those 400, 500, 600 different data points. I think externalizing that research, we wouldn't do that for financial analysis. Why would we do it for broader stakeholder analysis? So I think there are some opportunities there for the industry to take greater ownership of that. You know, I think it's really quite interesting, the identifying materiality and relevance. You know, for some companies that could be a handful of considerations. For more complex business models on a global footprint basis, there would be significantly more. So we encourage looking beyond the metrics themselves, but also that strategic alignment of intent, and different sectors will have different considerations. And I think, you know, if we just take a step back and look at some of the points around sort of the fusing of social inequality with climate change, you know, I think it is worth just reflecting on that 1.8 trillion that's been earmarked for the American Families Bill. You know, there's some really meaningful federal action proposed there in the context of parental and medical leave that goes some way to addressing the mass inequality. You know, we started to see that coming through. The deaths of Breonna Taylor and George Floyd last year really became sparks that ignited a wildfire that was ultimately found by economic and social isolation. And I think the sooner that we can that we can integrate these considerations, you know, whether it's you know, the landmark ruling that we saw from the coroner in the Elikasi Deborah case, where the coroner returned cause of death of air pollution, you know, is a really interesting and meaningful milestone for capital markets to consider that broader narrative. So it's not just about looking at metrics per se, but at the broader dynamic within the space, whether it's fuel poverty in the Texas big freeze and climate migration, tailings dams, you know, the Flint water crisis, Bangladesh crisis that happened a few years ago, the forced labour camps that have been in the news more recently. You know, there are so many examples of intersectionality. I think earmarking one or two single metrics isn't necessarily where we need to take the narrative. It's about looking at this broader, when you're allocating this capital, looking at it in the context of a framework that supports broader stakeholder integration. So you're looking at that behavioural element as well. You're not just tick boxing against given metrics, because we know what will happen. The companies will effectively support that focus. I'm trying to choose diplomatic words there. You know, the SEC have just launched a task force in the last few weeks that looks specifically at misalignment of corporate statement and action. You know, it's a really dynamic and fluid landscape at the moment. And I think for everybody at the symposium who is thinking about this, I think if we can just think about it in the context of balancing all stakeholders and the decisions that are being made, rather than tick boxing against individual specific metrics, I think that would be a big leap forward for capital markets and their role in addressing some of these broader systemic risks.
Could I add a couple of things there? Very, very interesting points there. But I think there's something like 360 sustainability frameworks out there, and it is a bit of a jungle, really. But I think what we view is that the TCFD framework is fundamentally a great one. It has really the sort of core elements of what you could look at really across many different areas, not just climate, but looking at the sort of governance, who is responsible, where does the buck stop within a company? Does it go high enough? Are the incentives in place? But also, very importantly, as was discussed here, was the whole sort of strategy and business model. How well does the business model actually take into account both the risks and opportunities of climate, for instance? But again, this could, you know, be a framework that could be used for biodiversity or for water, for instance, and looking at the risk management and the metrics. And I think just to sort of finish off on TCFD is that I think what TCFD manages to sort of, with this framework, capture is climate resilience, and that's at the heart of it. And I think it is a broader and better, and not completely comparable, of course, framework to, for example, net zero. And we are huge proponents of the TCFD for climate, but also more generally. But I would also add there that I think it's very, very interesting to look at the sort of positive data as evidence, and as evidence of business models that can provide the change and the sort of solutions for unmet societal and environmental needs that we so desperately are needing right now. And so we are looking, doing detective work, really, looking for the sort of companies that have evidence of positive data, whether it is around avoided carbon emissions. In other words, avoiding carbon emissions for others. There are not many companies out there in the whole universe of firms that have products and services that can avoid CO2 emissions for other companies. Those are good companies, and I know it's today in the net zero conversation a controversial one potentially, Do you count them in, etc.? But from an investment perspective, there's no question these are good investments. They are very well aligned and the enablers of carbon abatement and mitigation, etc. Obviously, the EU taxonomy is going to be, for instance, strengthening this and sort of the focus on looking at solutions, looking at opportunities. And for us, for example, CDP is a very good source for also this opportunity and solutions data. They do have one sort of box where you can tick as a company, do you have products and services that can provide CO2 avoidance for other companies? And that's a sort of gold dust area, and we've been engaging with CDP and other organizations to increase this sort of possibility and for companies to report on this data. It is an important message, and you can be, of course, skeptical. You should always be skeptical about greenwashing, etc. But it is an important signal about a company being able to provide solutions and having that business model that can improve things and actually affect change.
Sure, and I probably to bring it on to our final question for the Q&A, that's a pretty comprehensive answer, but Phil McNaughall, who's one of our panelists tomorrow, incidentally, has asked which standard setting bodies are leading the development of new standards and metrics. Are there any in particular that you'd highlight?
Well, I did mention TCFD. I think it's a rock solid framework. It is very specific, of course, for climate today. But the questions are the right ones, and it allows to talk about the opportunities as well. But I do think that SASB has done important work and very good work, and it's been a process that has been, very rigorous with consultations, and I've also been actually part of that, but also part of the GRI's development. And I shouldn't say that's also very well done. But I think the sort of SASB approach of trying to link in also accounting standards is absolutely critical. It is very difficult, I think, to change the financial system unless we have new accounting standards and that allow us to take a much longer term view, that allows us to actually incorporate, for example, the risks of climate and carbon, and also, for example, looking at human capital potentially as an asset as opposed to just a cost, etc., etc. So I think these are critical issues, and I think SASB has done a great work in sort of starting to integrate that into accounting systems that then will feed into the valuation models that that investors and portfolio managers will use.
Great. Oh, sorry, Abbie, were you going to?
I was just going to say we can follow up some reading material if it's of interest in the context of the different directives that can be used in standardisation. But what we need, worth reflecting that it took decades to do this on financial parameters. So this is to be encouraged. That there is this much thought and creativity and innovation going into the standardization, but it will be critical going forward. And I think that we will see convergence on that standardization soon. And I think we've got multiple initiatives across the globe delivering that. So we've also got TNFD, which I saw came into the questions as well on the Task Force for Nature-related Financial Disclosure. Natural capital is in the limelight. Really interesting in the last few weeks. Everybody knows about the semiconductor shortages that we have at the moment, given the virtual working environment that we've all gone to today as we are here. But that has led to a shortage in chips. TSMC, one of the largest companies who manufacture semiconductor chips in the world, is in a region which is subtropical, typically has very high rainfall. Semiconductor manufacturing is a really good example of identifying materiality and relevance factors like water intensity of production. There is a very severe drought in Taiwan at the moment that's having big implications solutions across the industry from an operational resilience perspective. TSMC is a market leader in their water efficiency of their production, so really interesting to see how they've been able to defend on a business continuity basis against that natural capital element. But as we go to price, water will have a price like carbon will have a price at some point beyond servicing via utilities. You know, as we go to maturation or perhaps adolescence of these considerations, you know, going forward on a 5-10 year forward basis, these are the issues that as us as investors will absolutely need to embed in the context of delivering against that fiduciary duty, which is where the conversation started in the context of returns, because they fundamentally underpin the ability of a company to deliver those returns.
Terrific. Well, I'm very sorry if we didn't get a chance to get to your question, but that seems like a natural time to draw this panel to a close. So a huge thanks to Danielle, Lisa, and Abbie for your time and insights. I think I probably speak for everyone when I say we're immensely grateful for both. So thank you ever so much. And thus concludes our first panel event, and what a first event it was. So audience, please feel free to take a break. We'll be back in just short of 15 minutes with our second panel event on impact investing starting at 2:45. So we'll see you then. Thanks ever so much.
Thank you. Thanks for having us.
Thanks so much. Bye-bye.